Well, joining me now for more on the market activity is Jeff Krumpelman. He's a chief investment strategist and head of equities at Mariner Wealth Advisors. Jeff, it's great to have you on the show this morning. And in terms of what you're watching in this market, what's of most importance to you this morning?
Well, I think we're kind of in this, whatever you want to call it, timeout period, this tariff timeout period. And it's really hard to look at the data, which we try to stay focused on over the next month or so. You've kind of got this dichotomy that everyone's talking about between soft data, consumers lacking in confidence, CEOs nervous, small business optimism is on the decline. And so in terms of the soft data, it's not looking very good, but we've had all this pre-tariff buying activity to get ahead of potential price increases and difficulty in stocking inventory. And so it looks like the hard data is, just okay, very good, very solid. I think we have to kind of just step back, take a little bit of a breather and see, is this hard data a mirage? And it's the soft data and the lack of confidence is going to take it down? Or are we going to be able to come through this with some trade negotiations that kind of get us through? And then, you've got tax cuts on the horizon. So I think we just have to step back a little bit and take a breather.
Interesting. So it sounds like you're expecting perhaps range-bound trading activity from here. Is that the case?
I think so. I think as we near, though, the July 9 date, where the tariff timeout expires, if we don't have more than UK progress, then I think this market is probably going to start getting nervous and could start to roll over. On the other hand, like coiled spring action, if we get some news flow that there is progress in these negotiations, I think the market could move up. So for a bit, yes, but as we approach that deadline, I think we could see rising volatility.
Look, we've seen the S&P 500 claw its way out of a brief bear market level there, a drop of 20% on the day that those 145% tariffs on China and its retaliation was announced. We've also seen it claw its way out of correction territory, which technically is a 10% drop from its all-time high. Amid this breather that you anticipate, Jeff, of course, progress on trade will help. But what does all of this mean for the Fed and how that factors into the path forward for investors?
So I think the Fed is kind of also in a timeout. They've got to see, and I think they've signaled this pretty clearly, that the tariffs are going to cause inflation to spike here, at least on a temporary, transitory basis. And they are not, because the hard data is strong right now, they're not in a position where they have to cut. So I think they are going to be data dependent. And if you do start to see unemployment spike quite a bit, I think they'll shift in their dual mandate towards, focusing more on a slowing economy and unemployment. But for right now, they've got to deal with an economy that's still expanding, and you've got inflation risks that are rising. And I think they're on pause. I think they're on hold probably through July.
Okay. So what is the best way for our viewers to strategically manage their portfolios in this scenario?
Yeah, exactly. So, after being bullish for 2 years, our thesis going into this year was clear air turbulence. And I think because we've got this position where if we get progress on either Fed tax cuts or tariff reductions, the market could spring forward. If we don't, it could fall. We've got wider range in outcome. You want to be balanced. You want to have offense and defense. You want to make sure there are no portfolio imbalances in there. Don't be overexposed to Max 7. Don't short them. Don't move away from them, but don't have high exposure, as high as you see in the overall index. Have some international. I think the idea of the U.S. being the envy of the world. I think we still have a very strong economy, but that premium that we've garnered over the last several years is probably going to shrink. And I think the European discount will also shrink. So have some international exposure and look at some alternatives. And if you have not pared back your overall asset allocation after 60% cumulative return over the last 2 years, you're right. We've clawed back and we're not down very much. It's not too late to go back to normal if your allocation has drifted well above normal to U.S. stocks over the last 2 years.
All right, Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors, Jeff Krumpelman, thank you so much for joining us from Cincinnati this morning.
Thank you. Appreciate it.